Last time we were digging into XTI Aerospace Inc., XTIA. Today we're shifting our focus a bit, still in the industrial sector, specifically aerospace and defense, looking at CPI Aerostructures Inc. That's ticker CBU. Now this company, they manufacture structural assemblies, integrated systems, kitted components, basically crucial parts for the global aerospace and defense markets. So the real question we're tackling today is this. Does CPI Aerostructures Inc., CVU, represent a genuinely compelling investment opportunity? Considering its strategic market position and honestly a recent flurry of contract activity? Or do its current pretty challenging financial metrics and maybe some longer-term performance trends, do they warrant a much more cautious outlook? Maybe even skepticism? I'll be making the case for CPI's strategic strengths and its potential for future growth.
And I'll be focusing on the concerns, really grounded in CVU's current financial state and the, frankly, quite significant risks that, seem inherent right now.
Okay. So, from my perspective, CPI Aerostructures holds a really crucial niche. Within the whole aerospace and defense landscape. They're not just, banging out any old parts. They're supplying essential structural components for some pretty significant defense programs. We're talking platforms like the E-2D Advanced Hawkeye. That's a vital airborne early warning aircraft. The A-10 Thunderbolt, tough aircraft there. The UH-60 Black Hawk helicopter, super versatile. And even the commercial S-92 helicopter. These are big, long-term programs, right? Many with huge global footprints. And what really catches my eye is the consistent news flow we've seen lately. It just indicates strong ongoing demand for their specialized stuff. Look at the recent announcements. We've got $2.5 million in purchase orders from the U.S. Air Force for T-38 aircraft mod kits. That's for Q2 2025 delivery. Not insignificant, right? And it speaks to ongoing sustainment needs for, critical training aircraft. Just before that, July 25, they got follow-on orders worth $2.4 million for welded assemblies. That's repeat business. That's always a good sign in this industry. Looking back a bit further, February 25, contracts from Sikorsky supporting MH-60 Seahawk helicopter sustainment. Again, sustainment implies that long-term predictable demand. And January 25, that was a really strong month. New orders for the UH-60M Black Hawk, another Sikorsky program, and a Lot 4 production contract for the Next Generation Jammer mid-band program from Raytheon. Now, this Jammer program, it's like cutting-edge electronic warfare, a super high-priority area. Being part of that really positions CVU strategically. And this pipeline, it goes back even further. December 24, a contract for the Next Gen Jammer low-band program from L3Harris. So when you look at this stream of activity, it just clearly demonstrates strong, forward-looking demand for what they do. And beyond just the contracts, you've also got significant insider ownership. It's nearly 30%, 29.28% to be exact, plus recent insider buying. That, for me, signals a pretty clear vote of confidence from the people who know the company best, right? Inside out. Like Director Carrie Bond bought 10,000 shares at $288 back in June 25. Pamela Levesque, another director, 10,000 shares at $313 in November 24. Richard Rosenjack, 5,000 shares at $337, also November 24. These aren't tiny buys. They show real conviction that the stock is undervalued. And there's been recent share price volatility, but the company has shown strong performance over a slightly longer view. Performance over 3 years is up an impressive 121.24%. That shows it can deliver significant upside.
Okay. I see the points on the contracts and the niche. And the insider activity is interesting. But I come at this from a different angle. And while those operational details are, part of the story, the cold, hard financial numbers, they paint a starkly different and frankly pretty worrying picture for CVU. The company shows significant, maybe even systemic financial weaknesses. Let's just start with profitability. It's not good. We're looking at a negative EPS, earnings per share, over the trailing 12 months. It's sitting at negative 0.07. And reported net income, negative 0.93 million. This isn't just like a bad quarter. This lack of profit seems to run deep. Key metrics like return on assets, ROA, is negative 1.30%. Return on equity, ROE, negative 3.87%. Return on invested capital, ROIC, negative 2.02%. All negative. These aren't just abstract numbers. They basically say the company struggles to turn its resources, its assets, its shareholder capital into actual profit. It points towards some fundamental inefficiencies. The profit margin is also negative, negative 1.29%. So moving on from profitability, the revenue trends, equally troubling, honestly. Sales year over year, trailing 12 months, down negative 14.35%. That's a big drop. And quarter over quarter sales fell even sharper by negative 27.06%. If you look longer term, sales over the past 3 and 5 years, also down, negative 7.78% and negative 1.52%. So this isn't a blip. It looks more like a consistent downward trend and actually bringing money in the door. Then there's the debt. The company carries a pretty notable debt load. Its debt to equity ratio is 1.12. That means it's leaning more on borrowed money than on shareholder funds. And the long-term debt to equity is 0.94. Now, for a company that isn't making profits, this kind of leverage is, well, it's risky. And cash, almost non-existent. Cash per share is just 0.05 cents, 5 cents. That leaves almost no cushion, for operational hiccups or unexpected costs. Then look at the stock performance itself. Mostly negative across almost any period you choose. Year to date, down a huge negative 38.27%. Past year, down minus 14.38%. 5 years, down minus 24.24%. And maybe the most alarming, over the last decade, it's plunged minus 73.12%. That kind of long-term underperformance is hard to just brush aside. Lastly, valuation. The enterprise value to EBITDA ratio, a key metric, is 28.00. That seems quite high, especially for a company with negative earnings. It suggests the valuation might be a bit rich compared to its actual operational cash flow. Like, investors are paying a premium for a company that isn't generating positive cash from its core business. And we can't just ignore the past SEC settlement from June 2024. That's not just some minor detail. It points to prior issues with governance or compliance that definitely need attention and, well, could shake investor confidence.
Okay. I hear you on those trailing financials, and yes, they are challenging, no doubt about it. But let me offer maybe a different way to look at it, especially when we talk about, the sustainability of these recent contracts versus that persistent unprofitability you laid out. You rightly highlighted the negative earnings, EPS, YY, TTM down over 100%. EPS, QQ down almost 200%. Negative profit margin. Yeah. But while those backward-looking numbers are weak, this sector, aerospace and defense, it operates on incredibly long procurement cycles. So what that means is there's often a significant lag, right? Quarters, sometimes even years, between winning a contract like these recent ones for the T-38 or the next Jammer programs, and when that revenue actually hits the books and impacts the bottom line. So these numerous recent contract wins, they signal a robust forward-looking demand. It just might not have fully cycled through the financials we're looking at right now. The company is working actively with big prime contractors, Raytheon, L3Harris. These are stable, fundamental relationships in this industry. These recent orders aren't just small potatoes. They represent real commitments for future work. My point is, they're strong indicators of future revenue. It suggests we could be looking at a potential inflection point, for both revenue and down the line profitability as these contracts move from just being booked to actual delivery and, well, getting paid for them.
The pipeline's filling up, and that's a crucial first step, isn't it, towards turning things around?
I get the point about long cycles. I really do. But my fundamental issue is still, how can this sheer volume of orders truly support a bullish case when the company consistently reports such deep losses? It suggests a basic problem in turning that activity into actual value for shareholders. You mentioned an inflection point, but where's the proof that these new contracts are actually structured to be profitable, or that the company's cost structure has magically improved to allow them to be? The past financials aren't just showing delayed revenue, they're showing persistent losses. If the execution consistently leads to losses, no matter how full the order book is, then the long-term value creation is, well, it's highly questionable, isn't it? We've seen years of falling sales and negative profits. Are we just supposed to believe these new contracts will suddenly be different? What specifically makes the margins on these projects better than the ones that led to the current mess? Without a clear sign that the underlying cost problems are being fixed, a full order book could just mean more work done, potentially at a loss.
That's a fair challenge on the profitability track record, and it's definitely a risk factor. But let's shift gears slightly. Let's talk valuation, debt, share price, but weigh that against the clear insider confidence and the very strategic niche CVU operates in. You correctly flagged the high EV/EBITDA of 28, and yes, the debt is considerable. However, CVU works in this highly specialized corner of aerospace and defense. It's a sector with incredibly high barriers to entry. You can't just, decide tomorrow to start making parts for a Black Hawk or a next-gen jammer. It takes specific certifications, deep engineering know-how, long-term government and military contracts that are really tough to win. These aren't just commodity parts. They're critical, high-value assemblies. Now, add to that the substantial insider ownership, almost 30%, and crucially, those recent insider buys. We talked about Director Kerry Bond, Pamela Levesque, Richard Rosenjack putting their own money in. That suggests a really strong belief in the company's long-term value, right? From the people who know it best. This internal confidence, especially directors buying shares, might just outweigh concerns about the current trailing financial ratios. It could be signaling that those closest to the company see an undervalued asset with significant future potential, even if the broader market hasn't quite seen it yet. It feels like a bet on future cash flows, not just the ones we see today.
See, I'm just not convinced that insider buying on its own cancels out such fundamental financial weaknesses. A debt to equity of 1.12 combined with almost no cash per share, just 5 cents, presents a very real, very significant financial risk, especially for a microcap company like CVU, market cap around $33 million. That high leverage is particularly dangerous at that size. It means a relatively small hiccup in operations or the market could have a huge impact. And its beta of 1.35 confirms it's more volatile than the market overall. What if a payment gets delayed or a project gets pushed back? That 5 cents cash per share gives them almost no room to maneuver. And look, the long-term stock performance is a serious warning sign. You can't just ignore a minus 73% decline over 10 years. It strongly suggests these risks have consistently trumped any perceived strategic edge or insider confidence. The market's been flashing warning signs for a long, long time. Ignoring that history, especially with such a fragile balance sheet, well, it seems unwise for an investor. Insider buying is interesting, sure, but it doesn't pay down debt or magically create profits. It's a signal, yes, but it's not a solution to the core financial problems.
Okay, it's a compelling point about the stock history and the microcap risks, definitely. But let's look at operational efficiency and the management changes, maybe in the context of those historical financials, and think about what they could mean for the future. You pointed out the fin margins, gross margin 15.16%, operating margin barely positive at 0.52%. And yeah, that makes profitability tough, especially with falling sales. And yes, the SEC settlement in 2024, it does cast a shadow on past operational integrity. Can't argue that. However, we need to look forward too. There are new management appointments. Paula Castellano came in as Senior VP of Operations in July 25. Kerry Bond, a seasoned aerospace exec, became chairman of the board in January 25. These moves seem precisely aimed at tackling these deep-rooted issues.
An SVP of operations. Their whole job is to optimize supply chains, streamline manufacturing, drive down costs, all things that directly impact those margins you mentioned. Plus, they're signing strategic long-term agreements, like the one with MST Manufacturing in June 25, designed to boost capabilities and maybe improve cost structures. These aren't just, cosmetic changes. They feel like deliberate, forward-looking steps trying to fix the very problems reflected in the past numbers. And remember that 3-year stock performance, up 121%? Despite recent issues, it shows the company has had periods of significant growth.
it indicates it can rebound strongly if these new strategies and the new contracts really start to pay off. It's not about ignoring history, but maybe recognizing that management is taking active, concrete steps to try and change the company's future path.
I'm sorry. I don't automatically buy that bringing in new people and signing agreements guarantees a fundamental shift. Not quickly anyway. Thin margins, as you said, they're tough to fix, especially in manufacturing. And without a clear, demonstrated turnaround in the actual financial results, these management changes are just potential. They're hope, not reality yet. How fast can a new SVP ops, no matter how good they are, really fix margins that have been thin for years, especially in a sector with these complex procurement processes? And that SAC settlement, it's not just a shadow. It was a compliance breach. It speaks to potentially deeper issues about corporate governance, internal controls. You can't just wave that away because there are new faces. It raises questions about the company's culture, doesn't it? And yes, the 3-year stock number is positive, but it's completely dwarfed by the negative 5-year and 10-year trends. That makes it look more like an outlier, maybe, than proof of a sustained ability to bounce back. I think the burden of proof is squarely on the company now. They need to show us tangible improvements in those profit margins and sales figures. Relying on promises of future initiatives or just one positive historical window, it's not enough. We need to see results.
So CPI Aerostructures really does present us with this compelling paradox, doesn't it? On one hand, you have a company with a strong, specialized niche in the defense sector, and it's backed by clear, recent contract wins that strongly suggest potential for, well, decent future revenue streams. But that potential, it's undeniably set against a backdrop of really challenging current profitability and, concerning debt levels.
Exactly. And while that recent contract activity is certainly notable, you have to pay attention to it. The persistent negative profitability, the clear trend of declining sales, and that significant long-term share price underperformance, they all combine to highlight substantial risks you just can't overlook. The company's ultimate ability to actually turn that strategic position into sustained positive financial results for its shareholders, that remains a critical, and I'd argue largely unproven question for anyone considering an investment.